and a lot of people wonder, like retirees with 401 accounts or people, just anyone who is still currently working with 401ks. Um, what do we do in a volatile market like this or not do?
Well, to your point about people didn't see this coming. Everybody knew it was coming, but they all thought they could get out before. And of course, you never. That sounds great, but doing it is you're unlikely to succeed. I think we need to step back here and give a little perspective on how well the market has done the last 18 years. If you look at the bottom in March of 2003, the Standard & Poor's has given you a return of 15% per year compounded for the last 18 years. I mean, that's just unprecedented. The long-term average is 10%. So people that have stayed in the market have done really, really well. And going forward, it's just unlikely we're going to continue to see that kind of return. In fact, we'll probably see less than a 10% return. So people may want to think about maybe taking some out of their stock allocation and take a little risk off the table right now. Even though I know the market's down, but we've come awfully far over a long period of time. And again, history says that's not going to continue.
So in terms of within your 401k, if you just want to move things around and, like you said, maybe reduce some of your higher risk, minimize that, where do you put it? I mean, it used to be put it in bonds, but
sure. And bonds have been a great investment as we've gone from a 15% inflation rate down to a 0% inflation rate. That's all played out now. So we're seeing interest rates go higher now, so you can get a higher yield on your bonds. But my suggestion would be, if you're going to go into bonds, look shorter duration bonds. Maybe you put it into like a 1 to 5 year bond fund rather than like a 20 or 30 year bond fund, because if rates keep going up, those bonds will lose value. Rising interest rates really hurt the value of long-term bonds. So I think to be prudent, I would put it in shorter term bonds.
Right. And so within the 401k.
Within the 401k, yes.
All right. So what advice do you have for small investors who may still have a little bit of money on the side? Is this a good time to get into the market?
Well, if you're looking at retirement assets, you need to just keep with the plan. You just need to keep putting your money away every month, maximizing the match that your employer has. If you've got other money outside of a tax deferred environment, my question would be, what's the purpose of the money? If the purpose of the money is a down payment for the house, you need to put it in treasury bills. You don't want to be putting it in the stock market. If you need that money 1 year from now, minimal risk. But if you're looking to maybe put something into a riskier asset, maybe consider dollar cost averaging in over the next, let's say, 6 or 8 months. So if it's 6 months, take 1/6 of it and invest it in stocks, and maybe just leave the rest in a money market fund. And that way, if the market keeps going down, you can average in at a lower price.
The labor market is tight, unemployment is low, but Wall Street seems to be bleeding. How would you describe the state of our economy right now?
Well, I think it's mixed. I think we have the inflation issues, and a lot of that is caused by energy prices. Every business, except oil and gas, frankly, energy is a cost, not a profit center. So that's affecting everyone. If you listen to the conference call yesterday with Target, their CFO said that they spent $1 billion extra in freight costs just this quarter. So it's getting throughout the system. It's going to make costs higher. The good news is, I think for labor I think we're moving more towards better returns for labor over the next 10 years than we've had in the last 10 years. It's really, globalization has made it very difficult to get raises here in the US and to improve your standard of living. And I think that's changing, and that's good for labor.